Financial mistakes of an average person. Common financial mistakes made by the ordinary person include not budgeting, not setting aside money for emergencies, disregarding retirement savings, avoiding financial education, and piling up high-interest debt. These mistakes could prevent long-term financial stability and expansion. Yes, let's explore each of these typical financial errors in more detail. Not having a budget. Your income and expenses can be managed with the help of a budget, which functions as a financial roadmap. Without one, you can wind yourself overpaying and experiencing financial stress due to reckless spending. You can allocate particular amounts to various areas, such as accommodation, food, transportation, and entertainment when you use a budget. This makes it easier for you to monitor your spending, make the necessary corrections, and make sure you're setting aside enough money for your objectives. Living beyond means. Spending more than you make is known as living beyond your means. Due to the fact that credit cards and loans are now your primary way of funding your lifestyle, this can quickly result in debt accumulation. The issue with this strategy is that it is unsustainable over the long term and can result in a vicious cycle of debt and hard times financially. It's critical to balance your spending with your income, put needs before wants, and look for ways to boost your earnings or lower your outgoing costs. Not saving for emergencies. Life will always involve emergencies. If you don't have an emergency fund set up, you won't be ready to deal with unforeseen costs like medical bills, auto repairs, or lost income. Relying on credit cards or loans for unexpected expenses can make your financial situation worse because you'll have to pay interest on the money you borrow. An emergency fund of 3 to 6 months' worth of costs serves as a safety net, offering comfort and monetary security through trying times. Neglecting retirement savings. Even though retirement may seem far off, delaying saving for it might have serious repercussions. Because of compound interest, your money will increase more quickly the sooner you start saving. By putting off retirement planning while you're still young, you effectively forfeit the chance for your investments to grow and generate sizable wealth. If you start saving for retirement later, you'll need to make higher contributions to catch up. Carrying high-interest debt. Due to the compounding nature of interest, high-interest debt, such as credit card debt, can quickly spiral out of control. In addition to eating up your income, this kind of debt lowers your credit score, which makes it more difficult and expensive to borrow money in the future. To free up your resources and prevent being caught in a loop of payments, make paying off high-interest debt your first priority as soon as you can. Impulse spending. The term impulse spending describes making purchases without giving them much thought. Because you're spending money on items that might not be consistent with your objectives or values, this behavior can undermine your efforts to invest and save. You may distinguish between actual needs and fleeting impulses by putting in place a cooling-off period before making large purchases. This will help you keep your spending intentional and in accordance with your financial plan. Ignoring financial literacy. Making wise financial decisions starts with financial literacy. Without a thorough understanding of ideas like budgeting, investing, taxes, and interest rates, you run the risk of making decisions that could be detrimental to your financial stability. Learn about personal finance through books, online resources, and financial courses to provide yourself with the knowledge necessary to confidently navigate the field. Failing to invest. Regular savings accounts may feel safe, but they are not a good long-term wealth growth plan. Your money may eventually generate larger returns if you invest. While investing carries some risk, you may use the potential of compound growth to your advantage by building a diverse portfolio that is suited to your risk appetite and goals. Ignoring long-term goals. Your financial decisions have a purpose and direction when you have long-term financial goals. It's difficult to efficiently deploy resources without clear goals. Having a clear strategy in place will enable you to make wise decisions, allocate resources, and maintain your commitment to your financial journey, regardless of whether your objective is to purchase a home, establish a family, travel, or retire comfortably. Relying solely on a single income source. You run a serious risk of financial ruin if you rely only on one job or source of income. Your principal income may be impacted by changes in the economy, business restructuring, or your personal situation. By generating additional income through side jobs, freelancing, or investments, you build a safety net that ensures stability, even if one source of income is unstable. Not negotiating salary. Your financial stability is substantially impacted by your earning potential. Throughout your career, failing to negotiate your wage can result in money being lost. Investigate industry norms, comprehend your worth, and successfully negotiate your pay. Even a modest increase in your initial income can result in significant gains in your lifetime earnings over time. Chasing fads in investments. It's simple to get swept up in the thrill of the moment when investing trends come and go. However, sound research and a clear grasp of the investment's fundamentals should form the foundation of every investment decision. Losses may result if you don't when the trend changes. A diversified investment portfolio with a long-term outlook is essential for creating a portfolio that is resilient. Missing bill payments. Missed bill payments, including those for credit cards or utilities, can have a domino effect. As late fees and penalties mount, your credit score could be impacted. Lower credit scores can result in higher loan interest rates or even trouble gaining loan approval. You may protect your financial security by setting up automated payments or using reminders to make sure your expenses are paid on time. Not shopping around. Failure to comparison shop might result in overpaying, whether you're getting a loan, purchasing insurance, or making a significant purchase. Terms, interest rates, and fees are all different between providers. Long-term savings can be significant if you take the time to compare choices. To make educated decisions, use internet comparison tools and ask for advice. Lack of estate planning. Making a detailed strategy for how your assets will be distributed after your death is called estate planning. Without a plan, your loved ones may encounter financial and legal difficulties, and your possessions may not be used in the manner you intended. Trying to keep up with others. Financial stress and debt can result from comparing your way of life to others, and from splurging to imitate their spending patterns. For a secure financial future, it's critical to base your financial decisions on your own aims and ideals rather than those of society. Not taking advantage of employer benefits. Benefits from your company. Such retirement plans with employer matching contributions can greatly improve your financial situation. By declining to participate, you are really throwing money away. Cash hoarding. Instead of investing, while storing extra money in low-interest savings accounts is crucial for an emergency fund, it also prevents your money from growing. Strategic investments can boost earnings and enable you to outpace inflation. You can create the foundation for a more stable and profitable financial future by being aware of these financial blunders and taking proactive measures to avoid them. You can successfully handle the intricacies of personal money by developing excellent financial habits, staying informed, and making deliberate judgments. We appreciate your presence today. Give this video a thumbs up if you liked it, and share it with other people who are interested in finance. Don't forget to subscribe and click the notification button to find even more insightful information. Till then, be wise and continue accumulating your cash.